Hi, this is Dr. Jenny Mitchell, and today we're going to talk about capital budgeting techniques, specifically net present value, internal rate of return, and payback methods. So let's take a minute to look at this setup. Just first to remind you, these are your discounted capital project techniques. That means they use a time value of money. So for example, net present value, if we have a positive amount, we would accept the project. It definitely uses time value of money. That's the main focus. And we'll talk about each of these as we work through them. So let's get started. In this scenario, Palm University wants to consider a practice gym that'll cost $500,000. The discount rate is 12%, and the project expects to have positive years of cash flow, 15 years of it. So you can see here, these are the cash flows. What would happen is you would have to actually estimate the operating revenue and operating costs, but you really only need the net cash flows to work with for the present value, net present value. So what happens is that you may not realize it, but you can do net present value in Excel. It's an Excel function. If I go up here to the function key, you'll see that I can click that and it brings that to mine. And here's net present value. If I click on this, you'll see this is the rate, and then I put the values in one after the other, separated. If you're doing it in the not using this function argument box, you could just do it with a comma. So for example, let me go ahead and get rid of that. Let me click on this so you can see. So here's the formula, the actual formula. Net present value, 12%, and then see where it says C12, then D12, and so on. All of those amounts all the way across, and then at the very end we subtract the 500,000 amount, which is considered an outlay. So that is net present value. And as you can see, it is positive, so that tells us to accept this project. Now, if that were the only project, that'd be okay. But what happens, a lot of times we have a competing project. And I'm going to come back to that last. I may even do a different video on it. But just to be able to show you how it works, when you want to do a profitability index, essentially what you're doing is you're doing a sum of the present value, and so this is the present value by each year. So if you look at this, it may be a little bit different. You may not have quite seen how this works, but essentially I'm saying in year one, the net present value of 70,000 that you get at the end of the year is going to be 62,500. And if you'll notice, as we go further and further and away from the current year, you'll see that that this 96,000 is only worth 48,000 currently. In fact, if we go all the way to the end of the file, you'll see here that 97,000 is only worth $17,813 rounded off. So it really, the time value of money is just like anything. A dollar would you take a dollar today or a dollar 100 years from now? Well, you know that dollar is going to be like a cent, so it's not worth as much. So to calculate the profitability index, you're taking the sum value of the future cash flows, dividing it by the initial investment, and so you end up with your profitability index of 1.20. Now we need something to compare it to be able to know whether or not this is the right project for us. So we'll get to that in just a minute, but we have now done the net present value. We've talked about the profitability index, but we don't have one to compare it to. And now we're going to talk about the internal rate of return. The internal rate of return is basically what it's calculating what we make on this project. Now, here's the thing. If we go back up here, we know that the project costs us 12%. Basically, that would probably be what we would be able to borrow in order to be able to do this project. this one is really easy to do, the internal rate of return. And basically all you're doing is the IRR formula, and you're doing the cash flows again, and then you're just putting in a guess. So I'll actually do this. It's so easy. I'll go up here to this and find the IRR, and maybe I have to type it for it to find it. Okay, here's internal rate of return. I click on this, and basically all I'm doing here is, if you set it up correctly, it's just really easy. We're going to highlight all of this from the 500,000 that went out in year 0 clear through the end year 15. We can put a guess in here, so I usually put in whatever my discount rate is. I put that in. You could leave that blank and it would still work. I say okay, and so what you see here is that I've calculated it so that you can see it. It is 15%, and the rule is, if the internal rate of return is higher than what it costs you, the discount rate or the required rate of return, you would accept the project. It does have, it is easy to do. It does have some pros and cons. One is that it's easy to do. It's easily understandable as well. But it can provide some conflicting NPV if you have mutually exclusive projects. So we'll talk about that more in the book, but this is so you can learn how to do the calculations. I'm going to go to another video then to show you how to do payback method. So off to the next one.